Buy now, pay later is one of the fastest growing industries in the world. I'm sure you've went online to try to buy something and then you got the option to buy it now and then you could make payments on it, pay it later without using any credit card whatsoever, sometimes even with 0% interest. It's a massively growing industry. In fact, it grew over 50% in less than just 1 year. There's many players in the space. One of them is Afterpay, and one of them is Affirm, which what Bill Gates bought in his latest 13F filings. Is very little bit of his portfolio in it, but over 35,000 shares at an average price of $119, which is similar to the price right now. We are now around 119, so you're buying it right now for what basically Bill Gates bought it at. Now in this video, I'm going to do a very deep analysis on the business model, on the financial, especially on the risks, because there's a lot of risk with this business model, especially some things in the numbers that a lot of people aren't talking about. Many people are just focusing on the growth with the company and the massive TAM, but are not talking about very critical risk. And we want to make sure that we're not overpaying if we buy Affirm right now. So I hope you watch the entire video and get some value out of it. So to make it simple, the company is trying to disturb the whole thing around credit cards and lending, buying things on credit, and is claiming that over, for example, 120 billion are from credit card interest, over 15 billion in late payment fees, and the technology is outdated in general. They are trying to do something better. How are they trying to make it better? They have, for example, no late payment fees. That's right. If you buy something with Affirm, no late payment fee. Flexible payment term options, never pay more than agreed, and transparent and easy to understand. And many people actually really trust Affirm much more than credit card companies. And I can see why there could be a huge market for that. For example, if we go here and we look at the savings rate in the United States, it fell back to pre-pandemic after the stimulus is over, and people don't have much money. They want to buy something. Maybe even their credit card is maxed out, or they want to pay lower interest. They can use Affirm for that, and they trust it, which is a very beautiful business model. Now, you may ask, why would someone still choose something like Affirm over a traditional credit card? It's much easier to use, yes, but for two main reasons. The first reason is that people now, this is a new trend. They're trying to be more, financially literate. But, this is maybe not the best way, but at least with them, you have a payment plan. So you know how much you're going to pay every 2 weeks and how much interest you're going to have and everything. It's very clear. But if you have a credit card, you're just going to keep paying the monthly payment, and then the interest is going to compound and compound and compound. But this is not with Affirm. You have a fixed payment you pay every 2 weeks or every month. So it helps you elaborate on your financials. The second reason why, because they have something where you could pay 0% interest. Now you're gonna say, how is that 0% interest? How will Affirm make money? They make money in two ways. The first way is with interest. The second way is they collect a fee from the merchant. So if they have 0% interest, for example, on Amazon, and then you want to buy, for example, a watch, but now you can borrow money, so you buy a watch and a hat, for example, you buy more from Amazon. So then Amazon pays a fee for Affirm because, you give them more business. So that's how they do it. The company is also trying to expand in other places like a virtual card. So let's assume you want to buy from any merchant that doesn't have Affirm, and you could just use your virtual card on your phone to pay for it with Affirm, which is beautiful. They have something like you could just shop on Affirm, they get referral fees, they have like a savings account, high interest, you could trade the Bitcoin and cryptos and all that kind of stuff. So it's all high margin stuff, and they're trying to expand, trying to come up with new things. And the company is just getting started in the US retail e-commerce, over 5.4 trillion. They can even, expand internationally. This is Affirm here, and this is a massive industry, so there's massive TAM. The company is growing very fast. Active customers over 124%, year over year to 8.6 million customers. Even the merchants that are partnering with Affirm have grown over 3.5 times, 1,400% growth. So massive growth. Now the revenue grew massively, also over 55% year over year growth, but the company is going all in. It wants even more growth. So it hit a huge deal with Amazon. And now whenever you want to go buy something on Amazon for over $50, you can use Affirm to pay for it, which is going to be huge for Affirm. It's going to be massive revenue growth and more, also name. People are going to know Affirm even more. But that came at a very expensive cost. For example, Affirm agreed to give Amazon over 22 million shares. Massive share dilution is going to come. And a lot of people got scared from that. Now, that's a very expensive deal for Affirm to give Amazon 22 million shares, for Amazon to use it. I mean, that didn't really make much sense to me. I honestly didn't like how the deal was structured, but they tried to structure it so it's not massive share dilution at once. It's going to be split by two, I believe they said over here. The first warrants, they come at 7 million shares, are spread out, until 2024. Then the second one from 2022 to 2028. But again, it's going to give massive revenue growth for Affirm, but I didn't like what they did with Amazon. They gave them 22 million shares. I tried to look this up, but I didn't really see if there's any contract between them. I believe it's until 2028, so around 6 years out. Now, after that, Amazon can do it on its own with Amazon Pay, or even Apple Pay or Google Pay. So it's a really low barrier to entry business, but they decided to choose Affirm. And I just let you know that usually Amazon is not very well known to make its partners rich. It usually wants the best for itself because it's dominant. It's like a monopoly. So it got the best deal with Affirm, and Affirm is desperate for growth, and it paid the deal. So the first risk with the company that many people overlooked is they use something called an ITACS score to determine if you are eligible to get the loan. It's not like a regular credit score. It's kind of their own kind of score. And from my understanding, it's very soft and very inaccurate. I'm going to explain to you why. For example, you have that score. It's over 100, which is the best. You have between 94 to 96. 90 to 94, under 90%, and then you have no score, so 0% score, like a credit score, but for them. Now, if you look, this is September, so if we go to September 30, this is the latest one. If you compare it with the other months, okay? This is here, it was 77%, 96 plus, so this is the best score. Then it went down to 75, 71, 66, 63. Now look at the scores that have no score, so 0%, no score. So you have no score, right? Nothing, zero, no credit, whatever. They still give you a loan, 5%, 5%, 7%, up from 2%. So they're giving more people loans that aren't qualified. They have zero score and they still give them a loan. So now over 9% of their total loan, 7 and 2, 9% have a bad score of under 90 and 7% has no score at all. Now what does that tell me? It tells me that Affirm is desperate for market share, is desperate for revenue growth, or else it will not give people that have no score over 7% of their loans, which is really, really bad. And that's leading to what? To loan delinquency. What is loan delinquency? When someone is late on their payment. For example, 96%, this is Q2, not Q3. I don't have Q3, but I'm sure it's even worse because on the numbers. But Q2 is 96% of people, they have no delinquency, so they're paying on time. 2.2% are 4 to 29 days late. 0.9% are 30 to 59 days late. Those yellow ones are 60 to 90 days late. So those people are never going to pay. These people over here, 0.3%, are over 100 days late on it, which is really bad. And why would they pay on time if there's no late payment fee? I mean, you have no late payment fee, you have nothing, only your credit score is gonna go down. Yes, it's gonna be affected, but you have no late payment fee. So why would you even pay on time, So it's very irresponsible. Plus, if you're not charging interest, the income of the person that you're trying to approve is gonna look way high because the expenses of the loan, if it's 0% interest, is gonna be low. So almost everybody gets qualified. This is like the 2008, the mortgage crisis all over again with the bank. And what is that leading to? To massive losses on loan default in the company. So if we go on the expenses, first we go on loss on loan purchase commitment. So they sell those loans to other banks from my understanding after they make them. But if they got very bad qualifications, they're not going to buy those loans. So they end up, maybe holding the loan, or they buy the loans for less money. They lost 51 million on that, a little bit less than what they did in last year. But if we look at the credit losses, which are people that are not paying, from 28 million to 63 million, almost triple on their provision of credit losses, which is really, really bad. It shows you that the company is essentially desperate for revenue and is doing anything. And this is really, really bad. Now, the company is not profitable, but it trades at a price to sales of 30 price to sales. So whenever we see something that high, we want to bet to make sure that the company is massively growing, which the company is expected to grow massively, 46 to 50% a year. And as we talked about, it has massive TAM for this company. But of course, it's not making a profit right now, and it's not expected to make a profit even in 2024. Now, I don't know if these estimates are correct or not correct, but I assume if AFRM wants to keep spending so much money on advertising, so much money on losing those loans to be desperate for market share, because there's a lot of competition in the space. PayPal is one of the biggest competitors. It has, buy now and pay later with PayPal, which is very, very successful. And they actually use real credit scores. They don't use those kind of scores that these companies use. Now, the valuation makes no sense to me, and I'm going to tell you why. Let's assume that they did hit on 50% growth every year. It could grow more, it could grow less. I usually never bet on 50% because anything can happen. But let's assume they hit the revenues for 2024. Now, if I put something realistic on the company, I put, for example, a 10 price to sales. This is only $27 billion market cap. Now it's sitting at $34 billion market cap, which is lower than the price today. If I put a 20 price to sales on it, which is much higher, maybe still less than 30, I would never bet on 30 price to sales, but let's assume you want to get 20. This is maybe, a $50 billion market cap, which is like 30-40% higher than it is today after 3 years of you waiting, after 3 years of you taking this massive risk. Now, that doesn't make much sense to me. Why are these companies trading at such a high valuation? Because they are innovators in a very high growth space that has a lot of hype around it, and whenever that happens, usually they get more very high multiple, and when the industry cools off, then the multiple starts going down. Same thing that happened, for example, with the MJ stocks. Maybe you owned one of the cannabis stocks. At the beginning, they had very high multiple, a lot of excitement. It's a new industry. And then when things cool off, they start dying out, going down, going down, and then they get to something, pretty realistic. Now, for me, honestly, that's why I think Bill Gates put less than 1% of his portfolio in it, because it's extremely high risk, but for a also very high reward. If you're willing to wait 10, 15 years, and then they get an establishment in the space, then they can be the best. But you have to remember, there's massive competition. Visa can do this. JP Morgan can do this. Banks can do this on their own. Apple, Google Pay, Amazon Pay, a lot of players can enter, very low barrier to entry. So for you to pay 30 times sales for this company, I think it's extremely overvalued. Personally, if I want to get exposure to this industry, I would go with something like PayPal. It's profitable, it has very sound fundamentals, and it's number one or number two actually in the space is PayPal with buy now and pay later. And remember, when this Amazon deals, they're going to give them those shares are going to be sold. So there's a lot of big, massive share dilution. If you own the stocks, you're going to get more diluted. They do have some cash, but if they continue losing money, they may need to dilute shares to raise more money to continue. So it's really not worth the risk reward for me. Especially betting on 40 to 50% revenue growth. Of course, they could do it. It's a massive TAM, but I would not personally bet on it, especially with a 30 price to sales. The stock is priced to perfection. Anything that could go wrong in this company, in my opinion, the stock can actually crash. As I said, I would prefer PayPal over the stock, but if you want to buy it for the long term, that's perfectly fine. Look at Bill Gates, even under 0.5% of his portfolio, because he knows how risky it is. So if you enjoyed today's video, if you got some value out of it, I thank you for watching. If you liked it, please press like and consider subscribing. I hope to see you in another video.